Hi, Jeff Higley with HotelNewsNow.com. We're here at the NYU Investment Conference in June, and with me are a couple of leaders from White Lodging in Merrillville, Indiana. Are all 155 hotels in the portfolio that are managed, are they all owned by White Lodging, or do you do third-party management?
You know, we, as a result of our kind of two milestone transactions in 2006, 100 of those hotels were sold to RLJ, and then approximately 33 to 34 of those are owned by Apple REIT. 16 of those of which we sold to Apple in November of 2010. So today, of those 155 hotels, internally owned hotels total 9.
How about the growth prospects for the management division of White Lodging? Where do you see that going? Do you have a goal in mind to add a certain number of contracts every year?
Well, our goal is we'd like to double in size over the next 5 years.
The development, White Lodging has always been a big developer. Always had a lot of properties in the pipeline. What are you working on these days, and how do you see the environment shaping that?
The big breakthrough for us in the last 90 days has been the debt, the banks, the regional banks and lenders coming through. While we're certainly not at the point we were, 2008 and prior. The fact is, we've got 4 projects we're going to start between now and the end of the year. 2 of them we have financing in place, and they're very strong, construction mini-perm loans relative to what was available the last 24 months. So that's been a big breakthrough for us. The other thing we're seeing in our development that's different than before is, as Dave kind of alluded to, we're shifting more toward fewer, larger scale projects. Historically, we might have had 1 urban project for every 8 to 10 suburban projects we developed. The urban project tending to be more in a 300 to 400 room range. Today, we've kind of flipped that, and probably 80% of our pipeline is urban 300 to 500 room a pop type developments.
Is it all development, ground up development for you, or are you looking at acquisitions as well to grow?
We look at acquisitions, but we're not a good buyer. As we heard in some of these sessions today, the acquisitions are averaging somewhere in the 5 to 7% cap range on trailing 12 NOI, and which usually equates to maybe 6 or 7 that first 12 months. And I think a lot of people scratch their heads when they look at us continuing to develop in this environment. But the fact is, we're underwriting at significantly higher returns for new development on those. I mean, generally, if we can't get to double digits by year 2 or 3, we're not going to do a new development. Profile of the projects we're speaking about, they're, as Dave mentioned, generally premium branded, select service, and urban markets. The markets I'm referencing where we'll be active here before the end of the year are in Chicago, Austin, Salt Lake City, and we're looking at a couple other markets, Nashville, et cetera. Those projects that we will be going on range anywhere from, call it 65 to 75% of construction cost, of total development cost. So we've got a quote that we're very enthused about that's a 75% of the total cost to develop. We haven't seen those type numbers in 3+ years. So, and that's literally within the last, kind of 2-3 weeks here. So we feel that maybe is a little bit of hopefully a watershed moment, because the value of that is obviously, not so much for the project itself, but for the other 2 or 3 lenders that we were talking to be aware that now banks are starting to lend again. So we view that as a very optimistic and positive indicator.
Deno Yiankes, thank you very much. I appreciate your time.
Thank you.
Dave
Appreciate
Sibley,
it very much.
thank you much.
Thank you.
Thanks, Jeff.